as well. But speaking about tires, well, Ceat, that's the one that's at 52-week high. Sonal is with us to run us through what's driving the stock higher. Sonal.
Thanks a lot for that. Well, there were some positive takeaways from the Ceat's investor takeaways, and they say that demand in the near term is going to be really strong, and near-term volumes will be driven by strong demand, especially in their original equipment segment. Exports, however, they think will remain subdued in the near term. However, growth will be driven by exports in the longer term. The near-term issues is something that could impact growth there. Rural demand is relatively weak across the replacement and the original equipment segments, both of them, and it is the European demand which is witnessing some headwinds, and dealers are not stocking up because of that. They speak about commodity prices as well, which have increased around 2 to 3% on a sequential basis. But despite that, they expect margins to remain stable on a quarter-on-quarter basis, and that is, of course, the biggest takeaway there. Ceat aims to go back to 10 to 12% margins versus 6% margins that they reported in Q1. So a big margin push is something which is exciting the stock today as well. FY23 capex around 900 crore rupees, 500 to 600 crore rupees in the second half of this fiscal is what they expect, and by FY26 they expect to gain leadership in 2 to 3 wheeler segment and also achieve leadership in passenger car radials. On the back of this, Nomura thinks that EBITDA margins will improve from 6% in first quarter to 10% by FY24 and 25. They have a neutral rating with a target price of 1,273 rupees per share. Along with this, the other tire stocks also doing well in trade today.
Okay, all right, Sonal, thanks a lot. So that's one space that is doing well. Well, let's focus on the metals.